folks. Welcome to another episode of our In the Know podcast. It's a podcast hosted by the Financial Services Practice Group here at Barry Dunn, where we talk about a bunch of ongoing trends in the financial institution industry. My name is David Stone. I'm joined today, as always, by Susan Weber.
Hi, David.
Hey, Susan. Glad to have you here again for another round of In the Know. And you know I say this every time, but we have another jam-packed agenda today. Lot to cover.
We sure do.
Yeah, even I don't know about you, but so Susan and I are in New England, and it's been hot and humid this summer up here in New England, and I think the same can be said for the banking industry. It's been hot and humid. What happening?
Oh my gosh, that is so funny, David. I'm right there with you on the weather analogy. I'm ready for some cooler weather.
Agreed. So I think we'll start off, sticking with tradition here with just some quick banking profile stats, and then we'll segue into recently issued accounting pronouncements. So on the stats front, what I'm sharing today is from the FDIC's Quarter 1 banking profile. So covering through 3/31/24, and just a few takeaways that I want to share with folks today. The first being net interest margin. I know I tend to always have a key takeaway here, and rightfully so. Despite net interest margins actually remaining consistent in the previous quarter-over-quarter comparison, it resumed to a declining trend coming into 2024. And probably no surprise there. And looking at quarter 1 24 to quarter 1 23, net interest margins actually dropped around 26 basis points. So pretty significant drop there, and it ended at 3.23% at the end of quarter 1 2024. Now that's just for community banks, and I will say, I want to add a good note in there that despite this decline, community banks' net interest margins actually continued to prevail over the overall banking industry's net interest margin of 3.17%. So
I feel
there's
like
a positive for you.
I feel like that warrants some clapping, David. Like, woohoo!
Sure.
Community banks.
I try to find the silver lining. I really do.
Well, and I have to say, it doesn't surprise me what we're seeing in the first quarter results that, recently were released. When we think about our own summit that we just had in Portsmouth, I know we mentioned it a little bit the last time we were on one of the In the Know podcasts, but when we asked people what was on their minds, that was one of the key net interest margins, and the future of net interest margin was one of the key aspects that we know that topics that people really wanted to talk about and really was on their mind strongly.
Yeah, absolutely. And another topic that's been front of mind is deposits. Deposits.
Yes.
I don't know the last conference or session I've gone to that hasn't talked about deposits, and again, rightfully so. And that was actually the next takeaway that I wanted to share here from the banking profile. More than half of all community banks, around 62%, actually reported an increase in deposit balances from the previous quarter. So good news there. However, again, probably not coming as a surprise. Most of this growth was in interest-bearing deposits, around $36 billion. And there's actually a decline in non-interest-bearing deposits of around $13 billion. So makes sense, when you pair that information with that net interest margin stat that I just provided. Growth in deposits, but more so in interest-bearing. Customers trying to capitalize on this current rate environment. So shifting to recently issued accounting pronouncements, it's been relatively quiet on the FASB front, Financial Accounting Standards Board. Really no ASUs have been issued of late that I want to highlight. I will say, there is still a proposed ASU out there on purchased credit deteriorated assets, and that non-PCD versus PCD treatment, which I actually spoke to at our Portsmouth event, and unfortunately really no updates since that event. It's still in deliberation, and they really haven't given an indication as to when a final ASU will be issued, unfortunately. So still in a holding pattern there.
But stay tuned, because guaranteed that the minute they issue it, David is going to be all over
it. You're setting the stakes high there, Susan. Yeah, but you are right. We'll be all over it once they do finalize that. I will mention, there are a couple other ASUs that have been finalized for some time now that will be taking effect. One being on the proportional amortization method and the expansion of that permissible accounting treatment for tax equity investments. I'll also mention, while we're on the subject of income taxes, there was an ASU issued late in 2023 that impacts income tax disclosures. So not the accounting for income taxes, but the disclosures of such. And, certainly an ASU worth taking a look at if you haven't already. So there might be some work involved there in gathering some information that you previously haven't had to gather for financial statement disclosure purposes. So with that, Susan, we were both in attendance at the recent FMS National Forum held in Boston, and what a great event. I know we want to spend a few minutes just sharing some takeaways from that event.
Absolutely. And for anybody listening who doesn't know what FMS is, it's Financial Managers Society. There are, chapters across the United States, but once a year they have an annual national conference. And as David said, this year it was in Boston. One of the very interesting things that happened towards the end of the conference was they had a regulatory panel, and it was all the chief accountants of the primary regulatory bodies, right? So it was the OCC, the FDIC, the FRB, and the NCUA, the whole alphabet soup of regulators were there. And what a great group, actually. Several of them, we had a session, and several of them attended our session and were very conversational afterwards with us about CECL and the space. And so we'll talk a little bit more about that. But one of the things that stood out to me a lot, David, and this comes from my credit risk management background, was I think it's telling when you have a 2-hour or 2.5-hour regulatory panel, when measurable time was spent reminding people about non-accrual accounting and OREO accounting, right?
Yeah.
And clearly, when you think about the OCC semi-annual risk perspective that came out this spring 2024, talking about that the risk for credit risk was increasing. Multifamily has now officially joined office as sectors that the regulators are most concerned about. There was a lot of really good information and data shared along what they're seeing and the trends that they're seeing. TREP, TREPP, is another resource that we often comment on. They are also monitoring what's happening in these two spaces. And so I think there's a lot here for bankers, especially community bankers, to be paying attention to. This sort of idea that maybe in some cases, some of the risk, the structure, the interest rate environment that we're in, we sort of kicked some of that risk. We kicked the can down the road a little bit on some of that risk, and there's going to be a price to pay coming up. I think there's a real concern that we're running out of runway on that. And so when the regulators are reminding people about, when things need to go on non-accrual and how to work through OREO accounting, it's time to dust off the playbook and make sure that we also have the right processes in place. And not for nothing, but you've had a lot of turnover in that space in banks in general, right? As people with the experience from the last recession have retired, they've moved on, that there maybe because asset quality has been pretty stable and good for a while. Do you have the right people with the right knowledge in the right places and the same networks of people ready to turn on a dime if things were to turn? So I think it's a really good time to take assessment of that.
Yeah, all great points, Susan. I couldn't agree more. The accounting for non-accrual for OREO hasn't changed, which I think really just proves the point even more that if the regulators from each primary regulatory body are talking about that and spending substantial time reminding people, you should probably listen. Your ears should probably perk up a little bit. And I do want to mention on the subject of Oreo, we actually have a great article available on the website. I'll make sure that we post a link to it, in this podcast, but definitely worth checking out. Just really boils down the accounting treatment for other real estate owned. So it could be a great resource.
And I will just put in a plug that, I think a lot of times people think about us for accounting rules, and I think that's appropriate and great. We also do consulting work in this space from a credit risk management perspective. So we have had several engagements recently where we've been chatting around these rules and helping folks put some extra policies and procedures in place that really address that, or at least assess where their gaps may be based on their staffing today. So, if there's anything that people would like to talk through or need some help with, please feel free to reach out to us.
Yeah. And one other topic I'll just mention briefly that the regulators touched upon, and again, no changes here in the accounting treatment, but goodwill impairment. Goodwill impairment came up just as a reminder, given this challenging environment, goodwill impairment might carry a little more significance than it has in the past, and specifically the assessment of if impairment actually exists with your goodwill. So probably doesn't impact everybody, listening in on this podcast today, just those that have been an acquirer of, a bank or even a branch of a bank. But, probably a good opportunity to revisit that as well. And I would suspect that, auditors, regulators will be taking a closer look at goodwill for those institutions that do have it on their balance sheets.
That's great. So let's talk a little bit about our CECL session from that great FMS event, David. This was a chance for you and me to kind of join forces and put some really, hopefully good and helpful information out there. I know we got a really strong response from the session, and it was really energizing to be part of. So what were some of the key takeaways that you felt were really important to highlight from that event?
Yeah. I'm glad you brought that up, Susan. So as Susan mentioned earlier, we had the pleasure of joining forces and doing a breakout session on post CECL implementation, takeaways, things to consider, and we focused on a few things, and some of the takeaways that I'll share from our session. One thing that we highlighted was finding that sweet spot for board reporting. So we talked a lot about, how there's just a ton of information now that we're under the CECL model, and finding that sweet spot, how much information is valuable to provide to my board on a monthly, quarterly basis is super important, and will probably be more of the focus as we are now in year 2, 3 of CECL implementation. We also talked about analytics and trend analysis and how these are still an important part of oversight. Now, I will say that some of the trends and analytics that you maybe relied upon under incurred loss, they might still be relevant, but they might not be as relevant under CECL as they were under incurred loss. So it might be time to revisit those analytics and trends that you've historically utilized in your oversight responsibilities. We also talked about peer comparisons and how that can be extremely difficult under CECL, just given the variety of models and calculation techniques. But even though it's difficult, I think that's still a really important exercise to go through. And I'll put in a quick plug. We actually have a benchmarking analysis that we have put together and is available on the website for download. And you may be thinking, well, didn't you guys do that previously? Do benchmarking analysis? You're not wrong. We did. We had a benchmarking analysis that we did primarily for the New England states. What this analysis does is, well, first it captures all that time that is occurred since our previous analysis, but it also expands to a national analysis, and looks at various regions throughout the country. So definitely recommend checking that out if you haven't already. Again, it's available for download. Make sure that we have a link on the podcast for that as well. And then the last takeaway I want to cover is you cannot outsource responsibility. And I'll provide a little context on that because, you might be like, what are you talking about, David?
I would love to outsource responsibility. Can I sign up for that?
No, not just with CECL, right? With a bunch of things in my
everything.
life.
Yeah, I have a number of things on my list I'd like to outsource, that's for sure.
No, but really the takeaway here was, many institutions are relying on service providers to help with their CECL calculation. And a lot of these service providers provide what's called a SOC 1 report. And those reports can be super valuable in monitoring those service providers. It's certainly not the only piece of evidence that you want to be using, but should certainly be one of the pieces of evidence that you're using in your ongoing monitoring of those service providers. So just wanted to mention that. And Susan, I don't know if you want to share a couple key takeaways from your segment.
For sure. I think the biggest thing that I could help coach people on is really thinking through a formalized model risk and model change management practice. I think everybody was very focused on getting a model up and running. They're still focused on assessing the performance of those models. It's still early in the model maturity process as to how they're feeling about the process and the model outcomes. But even with that, we are starting to see various model solutions and developers offering updates and changes to the math and new and improved ways of doing things. We're starting to see consolidation. We've been talking about the fact that we know consolidation must be coming in the industry. Yep. It was one of our kind of predictive things from last year's conference that is starting. But we've seen it already coming true. Just last week, Quick Rate, which is Quick Analytics, announced that they were acquired by Infusion Marketing Group, which is another analytics company. So right now we understand no immediate changes to the CECL solution product, but you don't know what's going to happen over time. It's prompted a flurry of conversations about business continuity and what happens if we want to, everything from just advancing their model or tweaking their qualitative adjustments or perfecting their qualitative approach to what happens if I need to find a different solution, right? Who is even out there still on the market?
Sure.
I've been answering a lot of those kind of calls and questions and trying to give people some guidance on, who all is out there that can be good resources for them. So, I think making sure that you've got a formalized assessment and change management process. What do these changes mean? Whether the developer is giving them to you and saying, we've made this change and there's no other choice but to accept it. But you still have the responsibility of saying, what does this mean to me, my outcome, my solution, and being responsible and accountable for that. So having a solid process for whether you're changing an assumption or tweaking an input or your or something in your methodology or your solution is doing it, there needs to be a discipline and an approach around how are we identifying it, what are we assessing, who gets to review and approve it, how do we log it and keep track of it. So over time, we know all the derivations that our model has been under. Yeah,
for sure.
And we do have a checklist for that. So a model change and risk management checklist was also part of our key resources for the FMS conference. So we have a bunch of things to link to today's podcast.
Yeah, I know. I was just thinking the same. So, geez, I gotta remember what we're promising here.
I've got a list going.
All right. Well, yeah, and you mentioned our Portsmouth session earlier, and geez, hard to believe that was end of May. Unbelievable. Here we are, midsummer. And just one quick takeaway I wanted to mention. A lot of great content. Always really enjoy partnering with Stifel to put on that event. And I know their chief economist, Lindsay, had a session on the current state of the economy, and definitely recommend, following her on LinkedIn. She always has a pulse on what's happening in the economy. And at the time, the FOMC had just had their May meeting and had indicated that inflation readings were still above expectations. And even in the short period of time, since that indication, seems like the dialogue has already started to shift a little more. And a possibility of rate cuts in the second half of 2024 is becoming more and more likely. Now, that could change tomorrow. I'm not saying that that's going to happen, but it just goes to show how quickly things are moving. In May, Lindsay provided her update indicating, it seemed like given the inflation metrics, rate cuts were becoming less likely in 24. Now here we are just a few months later, seems like they're becoming more and more likely. And then lastly, I think to wrap up today's podcast, Susan, just wanted to share a final rule that was recently issued by a bunch of regulators, FDIC, FHFA, CFPB, to name a few, on asset valuation models, automated valuation models.
AVMs.
AVMs, commonly referred to. And this final rule is actually the finalization of a proposal that was issued back in June 2023. And my understanding is that it's substantially similar to that proposal that was issued in June. And really the idea is that this rule will create the requirement to have some quality control standards around these automated valuation models, these AVMs. And essentially, for certain transactions that are secured by a consumer's principal dwelling, institutions will be required to adopt policies, practices, procedures, and control systems that are designed to establish some base level of quality control over these AVMs. And Susan, I don't know if you want to speak to that a little more from a credit risk perspective.
Absolutely. This has been a long-standing conversation in the industry ever since these models came about, and the advantage to using them is the speed with which people can get loans on the books and closed, and in a lot of cases it reduces the expense associated with the due diligence on property valuations. The problem is that sometimes you get what you pay for, and the reliability of these models to give you a valuation widely differs depending on where you are in the United States in particular. Where those models are just like anything else that you're going to get trained on, right? And any model that's getting trained, they're really great in areas where houses and communities and blocks and the community around it is very similar, right? So think urban areas with large pre-built neighborhoods when there's not as much disparity in terms of land mass and coastline and rural nature property and types of dwelling. Up here in New England, our property types can vary even on abutting land, right? And so what constitutes a neighborhood and a radius and how these valuation models are trained is really widely variant. And so, it comes back to the institution having, when you say, quality controls and policies and procedures, there also has to be a level of testing and acceptance that these valuation models are aligned with that market area and the experience that those bankers have of values in that immediate area, right? And there's no single way of doing that, but it does mean that institutions need to give a lot of thought about how they are going to put those supporting aspects in place, those quality controls in place.
Yeah, thank you for sharing that, Susan. And this is hot off the press, so I'm sure there will be more guidance to follow on this final rule, but certainly something to keep on the radar.
Mm-hmm. We're full of great news today, David, but we do have lots of resources out there. And I think what I have on my list is the Oreo article, the regional benchmarking, the model risk and change management checklist, just to name a few. So hopefully people will be on the lookout for that.
That's what I had on my list too. So I'm glad we're in agreement. Well, thank you to our listeners today for tuning in to another In the Know podcast. Thank you, Susan. Great chatting with you as always. And, to our listeners, we hope you'll tune in for the next episode. But certainly in the meantime, if you have any questions, any thoughts, feel free to reach out to Susan or I, or use our Ask the Advisor feature on the Very Done website. Happy to chat further. So thanks again.